Hey everyone, welcome back. Let's talk about money. Not just how to make it, but how to think about it. That's what Morgan Housel's book, The Psychology of Money, is all about. Now, Morgan's a Wall Street guy. But don't worry, this isn't about fancy formulas. It's about the stuff they don't teach you in school, how our minds, our emotions, impact our financial decisions. See, we all have this thing called behavioral biases. Fancy term for saying we don't always act rationally, especially with money. We get greedy when markets are up, scared when they crash. This book is about understanding those biases so we can make smarter choices and build real lasting wealth. Let's dive in. Ever wonder why some brilliant people are terrible with money? It's not about IQ, it's about behavior. Take it from me, I've coached some of the most successful people on the planet. Housel tells this story about Ronald Read, a janitor who amassed a fortune. Didn't inherit a penny, just lived frugally, invested consistently, and let compounding work its magic over decades. Meanwhile, lottery winners often end up broke. Why? Because they haven't developed the habits and mindset to manage wealth. It's not about how much you make, it's about how much you keep and how you grow it. Compounding is like a snowball rolling downhill. It starts small, but as it gathers more snow, it gains momentum. That's your money growing over time. Let's say you invest £1,000 today, and it earns a modest 7% return per year. After 10 years, you'll have almost doubled your money. But here's the kicker. You didn't lift a finger for that extra grand. The longer you let your money compound, the more powerful it becomes. This is why it's so important to start investing early, even if it's just a small amount. Listen up, folks. Saving isn't sexy, but it's the foundation of financial freedom. It's not about deprivation, it's about having options. Think of it like this. Every pound you save is a brick in your financial house. The more bricks you have, the stronger and bigger your house can be. Now, I'm not saying you have to live like a monk, but small changes add up. Brew your own coffee instead of hitting Starbucks every day. Pack your lunch a couple of times a week. You'll be surprised how much you can save without even feeling it. Section 5. Risk and regret. Two sides of the same coin. We all hate losing money, right? But here's the thing. Avoiding risk altogether is risky in itself. You risk missing out on potential gains, and that can lead to regret. Remember the dot-com bubble? Everyone was getting rich except those too scared to invest. Then it burst. But those who stayed invested, even through the crash, came out ahead in the long run. The key is to understand your risk tolerance and invest accordingly. Don't put all your eggs in one basket. Diversify your investments and be prepared for some bumps along the way. Section 6. Tailwind versus headwind. Luck plays a role. Let's be honest, luck plays a part in everyone's success. Some people are born into wealth. Others hit the jackpot with a business idea. But here's the thing. You can't control luck. What you can control is your response to it. When you get lucky, be grateful and leverage that luck to your advantage. When you face headwinds, don't give up. Adjust your sails, learn from your mistakes, and keep moving forward. Section 7. Freedom, the ultimate prize. What's the point of all this financial stuff anyway? For me, it's about freedom. Freedom to do what you want, when you want, with who you want. Maybe it's early retirement, starting your own business, or simply having the peace of mind that comes with financial security. Money is just a tool. It's up to you to decide how you want to use it to live your best life. Section 8. Practical tips for your money journey. All right, let's get practical. Here are a few takeaways from Housel's book that you can start using today. Automate your savings. Set up a system where a portion of your income goes directly into savings or investments. Invest in low-cost index funds. You don't need to be a stock market whiz to invest successfully. Index funds offer broad market exposure at a low cost. Avoid debt like the plague. Debt is a wealth killer. Pay off high-interest debt as quickly as possible. Live below your means. You don't need to keep up with the Joneses. Focus on building wealth, not showing it off. Be patient and persistent. Building wealth takes time and effort. Don't get discouraged, stay the course, and you will see results. Gap 3S. Section 9. The importance of financial education. Understanding financial principles is the cornerstone of wealth building. Financial education goes beyond knowing how to save or invest. It's about comprehending the bigger picture of how money works. When you educate yourself financially, you empower yourself to make informed decisions that can lead to long-term financial stability and growth. Financial literacy helps you avoid common pitfalls such as high-interest debt, poor investment choices, and living beyond your means. It equips you with the knowledge to navigate the complex world of finance, from understanding interest rates and inflation to mastering the art of budgeting and investing. Moreover, financial education is an ongoing journey. The financial landscape is constantly evolving, and staying informed ensures that you can adapt to changes and seize new opportunities. Whether it's through books, online courses, or financial advisors, investing in your financial education is one of the best investments you can make. Remember, knowledge is power. The more you know about how money works, the better positioned you will be to make it work for you. So take the time to educate yourself, stay curious, and keep learning. Your future self will thank you. Gap 3S. Now let's move on to your call to action. Gap 3S, Section 10, Investment Strategies for Beginners. Investing can seem daunting at first, especially if you're new to the financial world. But with a few foundational principles, you can start building a portfolio that works for you. The first step is understanding the importance of diversification. Don't put all your eggs in one basket. Spread your investments across various asset classes like stocks, bonds, and real estate to mitigate risk. Next, consider your risk tolerance. How much risk are you willing to take? Younger investors might opt for a higher risk-reward ratio, while those closer to retirement might prefer safer, more stable investments. It's essential to find a balance that aligns with your financial goals and comfort level. Another key strategy is to invest consistently. Whether the market is up or down, regular contributions to your investment portfolio can smooth out market volatility and compound over time. This approach, known as dollar-cost averaging, reduces the impact of short-term market fluctuations. Don't forget the power of compound interest. The earlier you start investing, the more time your money has to grow. Even small, regular investments can accumulate significantly over the years, thanks to the magic of compounding. Lastly, educate yourself continuously. The investment landscape is ever-changing, and staying informed can help you make better decisions. Resources like financial news, investment courses, and advice from seasoned investors can be invaluable. Remember, investing isn't about getting rich quick, it's about building wealth over time. Start with these basic strategies, stay disciplined, and keep learning. Your future financial self will thank you. Gap 3S, Section 11. The role of patience in wealth accumulation. In today's fast-paced world, patience is often overlooked, yet it is a cornerstone of successful wealth accumulation. The journey to financial prosperity is rarely a straight line. It's filled with ups and downs, market fluctuations, and unexpected hurdles. Patience allows you to navigate these challenges without making impulsive decisions that could jeopardize your long-term goals. Consider the story of Warren Buffett, one of the most successful investors of all time. His wealth didn't accumulate overnight. It was the result of decades of disciplined investing and the power of compound interest working its magic over the long term. Buffett famously said, The stock market is designed to transfer money from the active to the patient. Patience isn't just about waiting. It's about having a long-term vision and the discipline to stick to your financial plan. It means resisting the temptation to chase after the latest investment fads or panic during market downturns. Instead, focus on your long-term goals and trust in your strategy. Remember, the market will have its highs and lows. There will be moments of doubt and fear, but those who remain patient and stay the course are often the ones who reap the most significant rewards. Patience also means giving your investments time to grow. The longer you stay invested, the more you benefit from compound interest, which can turn modest investments into substantial wealth over time. Ultimately, patience is about understanding that wealth accumulation is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and trusting in the process. So, as you embark on your financial journey, remember that patience is not just a virtue, it's an essential ingredient for long-term success. Gap 3S. Section 12. Avoiding common financial mistakes. Even with the best intentions and a solid plan, it's easy to fall into common financial traps that can derail your progress. Let's explore some of these pitfalls and how to avoid them. First up, living beyond your means. It's tempting to spend more as you earn more, but this can lead to a vicious cycle of debt. The solution? Create a budget and stick to it. Prioritize saving and investing over unnecessary spending. Next, neglecting an emergency fund. Life is unpredictable, and unexpected expenses can arise at any time. Aim to set aside 3 to 6 months' worth of living expenses in a readily accessible account. Another common mistake is not diversifying your investments. Putting all your money into one asset class can be risky. Spread your investments across different sectors and asset types to mitigate risk. Then there's the danger of trying to time the market. Many people make the mistake of buying high and selling low in an attempt to outsmart the market. Instead, focus on long-term investing and maintain a well-balanced portfolio. Failing to plan for retirement is another significant error. Relying solely on state pensions may not provide enough for a comfortable retirement. Start contributing to a retirement fund as early as possible to take advantage of compound interest. Finally, ignoring the impact of inflation. Over time, inflation erodes the purchasing power of your money. Make sure your investments outpace inflation to preserve and grow your wealth. By being aware of these common financial mistakes and taking proactive steps to avoid them, you can stay on the path to financial success. Remember, the goal is to build sustainable wealth, not just quick gains. Be mindful, stay informed, and make decisions that align with your long-term objectives. Gap 3S, Section 13. The future of money. As we look to the horizon, the world of finance is undergoing rapid transformation. Emerging trends and technologies are reshaping how we think about, interact with, and manage money. One of the most significant developments is the rise of digital currencies. Cryptocurrencies like Bitcoin and Ethereum have gained mainstream attention, offering a decentralized alternative to traditional banking systems. These digital assets promise faster transactions, lower fees, and enhanced security. Next, we have blockchain technology, the backbone of cryptocurrencies. Beyond digital currencies, blockchain has the potential to revolutionize various industries by providing transparent, tamper-proof ledgers for everything from supply chains to voting systems. Then there's the growing influence of fintech companies. These agile startups are leveraging technology to offer innovative financial services, from mobile banking and peer-to-peer lending to robo-advisors and personalized investment platforms. Artificial intelligence is another game changer. AI algorithms are being used to analyze vast amounts of financial data, offering insights and predictions that were previously unimaginable. This can lead to more informed investment decisions and better risk management. Moreover, There's an increasing focus on sustainable and ethical investing. Investors are becoming more conscious of the environmental and social impact of their investments, driving the growth of ESG, environmental, social, and governance funds. Lastly, the concept of a cashless society is becoming more tangible. With the rise of contactless payments, mobile wallets, and digital banking, physical cash is becoming less relevant. This shift could lead to greater financial inclusion, making it easier for people around the world to access financial services. These emerging trends and technologies are not just changing the way we handle money, they are redefining the entire financial landscape. Staying informed and adaptable is crucial as we navigate this evolving terrain. The future of money is exciting, full of opportunities and challenges. By embracing these changes, you can position yourself to thrive in the new financial era. So there you have it, the key takeaways from the psychology of money. But here's the thing. Knowledge without action is useless. Don't wait for the perfect time to get your finances in order. Start today, even if it's just a small step. Remember, financial success is a marathon, not a sprint. By understanding the psychology of money and developing sound financial habits, you can achieve your financial goals and live a life of abundance. Now get out there and make it happen.